And it comes, of course, as we are seeing some growing optimism south of the border about not just their retail sales number, which was strong in January, but also about the path of reopening and vaccines and herd immunity. Royce Mendes is with us now, senior economist at CIBC Capital Markets. And Royce, it is starting to feel a little bit like a tale of two economies. Now, sometimes our data is slower to arrive and more accurate, but in this case, we're looking at January numbers, and they're just not as strong as the U.S. So what do we make of what's happening here?
Well, I think what you saw in the U.S. was that short-term boost of those $600 checks. I think some economists had underestimated how much American households would spend out of those checks, and they were really blown away. We don't have those checks here in Canada. Now, we have generous fiscal support. You saw the Prime Minister extend some of those unemployment benefits further into the future, but we simply didn't have that one-time fiscal shot in the arm. And then looking down the road, we don't have the other shots in the arm. We don't have the vaccinations yet, and we also don't have, a huge fiscal package like the U.S. does coming down the pike, which is going to include another $1,400 worth of one-time checks sent out to households. And now the question is, how much of that $1,400 is going to translate pretty quickly into spending?
And what's your thought about that? I mean, that's going to be the all-important question, right? And it's one that I think our federal government is sort of counting on, that you do get that preloaded stimulus, as it were. How quickly does it turn into that?
Right. So what we know here in Canada is that once we start to reopen, as long as Canadians revert back to their previous spending patterns, so if they went out for dinner twice a month, they go out for dinner again twice a month. If they were going to get their haircut once a month or once every 2 months, they go and do that again. You can see a really big ramp up in aggregate demand here north of the border. And that'll be enough to propel us towards pre-COVID levels of GDP. If we get that extra fiscal boost that you're talking about, that more than $100 billion sitting in Canadian checking accounts, then we're going to start to recover all the faster. And the question is then, what does this mean for the timing of central banks? And you're sort of starting to see that question play out in markets with some of the rotations and the volatility we've been seeing of late and the rising interest rates.
Yeah, I want to talk about that a little bit when we see those yields going up, and just the context, obviously, that we're still, even at 1.5%, 10-year Treasury is by no means a high rate. But at what point does it get the market's attention, do you think? And when do you kind of see traction on how assets start to get repriced and people start to actually rotate out of those assets that are riskier and into those that are safer?
Well, that's the discussion happening in the U.S. There are economists on both sides of this debate. The economists that are worried about the size of the U.S. fiscal stimulus are not really actually worried about inflation running away. They're worried about what it means that the Federal Reserve has to do and whether it has to chase inflation, which would cause a lot of market disruption. I think you're starting to see that sort of price in, but as you rightly point out, these are still very low levels of yield, and I think at this point they're still unconcerning. However, if this trend continued and we started to see more and more signs of inflation starting to pop up, which the Federal Reserve would have to then, down the road at some point, but have to maybe raise interest rates faster than it otherwise would have, then we question, whether it tips them into a situation where, they actually end up doing some damage to the economy as they're trying to slow the pace of higher inflation.
So one of the interesting things, of course, is we have this voices out there in the U.S. It was Larry Summers last week speaking to the media, as far as I know, nowhere else, that perhaps the Fed will have to move sooner than the market thinks. That's just one guy's opinion. And of course, he's obviously a fairly credible guy. But does it surprise you when you see markets reacting to that perhaps the Fed moves? And we're not even talking about this year still. People are still talking, sometime in 2022 instead of 23. Would you expect a big market reaction if you're pulling it back even by 3, 4, 6 months?
Well, I think the question that Larry Summers has and Olivia Blanchard has and maybe Jason Furman has in the U.S. about this is how high they have to move and how quickly they have to move. I think the pulling forward of the timing, maybe we do get a rate hike now at the end of 2022, is not really the big question. It's how much they have to react to this and whether that magnitude and the pace of change is overly disruptive. I think on both sides of the debate, Larry Summers and then on the other side, pretty prominent economists like Janet Yellen and Paul Krugman all agree that we should be running the U.S. economy hot. Larry Summers has been talking about this for a long time. It's part of his thesis that we are in currently a secular stagnation sort of environment, and you need to run the economy a little bit hot. But he's suggesting that we don't do it with transfers to households and businesses, that we do it through investment. And so it actually grows the potential of the economy. And it actually means that you're growing the economy with fewer concerning inflationary trends. And that's really the debate. It's really about, is the size and the composition of this package right? And, you know, it may be one guy's opinion, but as you point out, it's Larry Summers, and he has a history of making calls that the market pays very close attention to. So I think we should continue to follow this debate and see actually how the data respond. In fact, you know, the retail sales data from January in the U.S. seem to suggest that Summers is at least somewhat correct, that more of this will go into spending than I would say economists like maybe Paul Krugman had previously expected.
So one of the things that appears to be happening here, and you know, it's early to say this, Royce, but we still have health officials on this side of the border saying, yes, the overall COVID numbers are coming down, but we're worried about variants. And last week they said, in fact, they think we need stiffer lockdown measures right now, not looser. In the U.S., you're seeing mainstream media now saying summer looks good. We're out of the woods here. You know, we're looking forward to a rebound and a normal summer. Does it matter which is the true story? And I say what I mean by that is, if the U.S. economy is tracking to reopening, is that just so good for Canada that it'll pull us along with it?
Well, not in the short term, right? Because these bricks and mortar retailers or restaurants and bars or travel service companies have been hit really hard. And if we continue these shutdowns, they're going to continue to feel the pain. However, there's not such a clean trade-off between the shutdown and economic activity, right? If we opened up and everyone was free to do everything they wanted to, but virus cases were raging again, people will probably choose, and we've seen this data in other jurisdictions, not to go out and partake in those activities. However, you're absolutely right. Down the road, once we start to fully reopen, and we can reopen without looking back in this country, and hopefully that does happen at some point during the summer, maybe later in the summer than in the U.S., but it happens sometime in the summer in Canada as well, we can start to respond to some of that excess demand that could be coming down the pike in the U.S. as a result of this $1.9 trillion. As we know, anytime the U.S. economy is firing on all cylinders, that means really good things for Canada. And if we can get our economy back to a place where we can serve those U.S. customers again, we're going to be benefiting from that $1.9 trillion, particularly if the U.S. economy reaches its capacity and can't produce enough to fulfill the demand of U.S. consumers. Then that demand is going to spill over. And where is it going to spill over? Well, it's going to spill over to one of their largest trading partners, which is us right here in Canada.
Royce, always good to have you with us. Appreciate it. Royce Mendes, senior economist at CIBC Capital Markets.